stocks. Tech stocks are continuing to get battered amid the broader market sell-off, with tech giants like Meta, Alphabet, and Netflix all down significantly year to date. Cowen's senior analyst John Blackledge joins us now to discuss here. And we had seen some of these tech stocks moving in lockstep, particularly with what the Fed was signaling. And so now that the Fed has made their decision yesterday and kind of telegraphed what the pathway forward may look like, how do you expect tech to continue to react from here?
Yeah, I know, and thanks for having me on. We had a couple notes. It's interesting, we had a couple notes out this morning on Alphabet and Meta. We did just mid-quarter ad checks, right? With all the macro headwinds, rates and inflation, geopolitical, we're just curious. We checked with our agency that we use, our digital ad agency, to see what, where we were for Meta and Alphabet 2Q to date through May. It was interesting for Meta. Our agency saw ad spend down about 4% through May. We have for the full quarter plus 2%. So it's tracking below where we are for the full quarter. But remember last year, the iOS 14.5 changes started in 2Q21, so the comps actually get easier for Meta as we get through the quarter. So probably our numbers probably still okay. On the go forward, it's a bigger question, and the question would be about ad demand with the rising rates and all the macro headwinds, and we'll try to examine that as we get through the back half of this year and into next year. And then for Google search, our agency check was 18% growth. Through May, we're at 16% for the full quarter. So, kind of tracking relatively in line with where we are. And it's a little bit of a decel from the first quarter growth rate. So, it seemed, despite everything that's going on, the numbers for the two companies seem to be tracking, the near term numbers seem to be tracking kind of where we are.
Hey, John, it's Julie here. Is there, though, when you're looking at that ad spend, is there a direct correlation between higher rates and a slowdown in ad spend? I mean, and a direct correlation through several layers, right? If higher rates are affecting, consumer spending on the margin, and then that affects these corporations, and then that affects what they're spending on ads. Do you expect to see a more severe feed through as rates continue to move up?
Yeah, there historically for advertising, there's a direct correlation with GDP growth. So to the extent that the higher rates lead to, kind of slowing GDP or declines, people are calling for a recession at some point, maybe back half of this year and the next year. And so if you look at, I think the thing that matters is what is earnings next year for these companies. Are the rising rates and the macro headwinds, are they factored into stock prices right now? If you look at, just take Alphabet. In the 08-09 recession, they obviously see the demand dwindling during that time period, and they put the brakes on cost growth. In 09, their cost growth was 0%, and their earnings were kind of in line with 08 levels. And as 08 was getting into 09, you saw the cost growth slowing down and then just flat in 09. So I think, for these companies, and you also saw in 2020, when COVID hit, both Alphabet and Facebook wasn't public in the 08 recession, their cost growth really, they put the brakes on costs. So that's what we're kind of going to be looking for. And they're going to see slower demand before any of us see it. And then I think they'll act on that. And even for Meta, they're losing a lot with their metaverse investments. And you're seeing reports since they report at 1Q that, kind of they're slowing hiring. So we'll have to see. But in the near term, it looks like things are kind of where we think they should be, but obviously there's interest rates and all of the headwinds are clearly going to be around for a bit, and so we'll try to do the best we can to forecast, kind of through the year and into next year.
John, how bad does it get for Netflix in a recession?
It's interesting. We did a ton of work on their potential ad business that we published that yesterday, and I would say what's interesting is we think they're going to introduce an ad tier. Our work, and we do a lot of survey work, monthly proprietary survey work at Cowen, and our work suggested that if they introduce a new lower price ad tier, they could add up to 4 million new members in 2023. And we think they're going to introduce the ad tier sometime late this year, fourth quarter. And so 18% of people, of non-member respondents, said that they were either extremely likely or somewhat likely to sign up for a new lower priced ad tier. What does that mean? Well, it means from a revenue perspective, we get to about $900 million in incremental revenue from those members. And how, like, what does that look like? Well, we get to about $17 in revenue per member per month for a new ad tier. And that's broken into a $6.99 subscription fee, which is kind of around where other premium streaming platforms are. It's also 30% below Netflix's basic tier, which is its lowest price tier. And then we got to about $10 a month on the ad side. But to the question, if they offer a new ad tier, it's going to be cheaper, either for new members or if existing members want to switch. Like, for instance, we also asked the question to existing members, like, would you switch to a lower price ad tier? And 41% said that they would switch. And you guys probably know that Netflix currently has 3 tiers, the basic at $9.99, the standard at $15.49, premium at $19.99. And half of the basic members and 40% of the standard and premium members said that they would switch. So if they do switch, and what's interesting about the basic member switching, the $9.99, they're paying $9.99. They would feel good. Yeah. Going to $6.99.
But
right?
John, let me ask this, because isn't it a big longer term risk for Netflix if you have people switching from higher price tiers just to these lower price tiers? Doesn't that over time bring their margins down? Does it hurt their cash flow?
No, that was the whole thing with our work yesterday. Just take the switchers, for instance, which we were curious about it. I think it's a great question. We think they're going to generate about $17 per member per month for an ad tier. The blended ARPU for the company was about $15 in US and Canada in 1Q. So net it's going to be incremental. And we're after we did the work, we were talking about it, saying they probably should have done this sooner. So no, I think it'll be net incremental, and that's why we called out yesterday. It is a positive multi-year revenue opportunity for the company.
John, always good to catch up with you, and especially right now, given what we have been seeing in technology. Stay strong, man. John Blackledge, good to see you.
Thank you.
Marriott Vacations is launching a new ownership program, Abound, targeting leisure travelers as the hospitality industry looks to capitalize on the summer season and bounce back from COVID-19. Joining us now to discuss is Marriott Vacations Worldwide CEO Steve Wise. Steve, good to see you here this morning. So talk us through a little bit about this program. Why now?
Well, thanks, Brian. Appreciate it very much. If you step back from it and look at it, I mean, leisure is absolutely booming, and we're very well positioned for that because we're 100% leisure focused with some of the greatest brands in the travel and hospitality business. And as we have looked at it, and we understand that vacations are becoming less of a discretionary decision. Many people now think that they're going to take a vacation regardless of what happens in the economy. We have gone about over the last 2 years kind of repositioning our offerings going forward to try to come up with what we think is the next generation of vacation ownership. And as a result, we've launched an initiative called Vacations Next. And a big component of that is our Abound program, which we announced this morning. And what that does is it allows the members of our 3 different Marriott branded vacation clubs that heretofore have interacted independent of one another to be consolidated into one program with a single currency and the ability to be able to travel across 90 properties, et cetera. So we think with that and the relevance of vacations becoming even more important, that we're very well positioned for the future.
Steve, when you look at all the incoming data in your business, are you seeing any signs of a more cautious consumer?
At this point in time, no. We're running some of the highest occupancies we've ever seen. And I think a lot of that has to do with the fact that we have our owners that bought the product and want to use the product. They want to be on vacation. And as a result, they're out traveling as much as possible. In fact, if you look at our forward bookings for both owners and our preview guests, they're up about 14% for the balance of this year over what they were at this time in 2019, pre-pandemic. So we're not seeing anything yet. Having said that, obviously, we'll keep our eye on it and try to react to it accordingly.
When we look at the rate environment right now, Steve, what kind of effect are we going to see on your what kind of effect are you guys going to see on your business as a result of that, even as you're seeing this high demand from customers?
Well, I assume you're talking about lending rates?
About interest rates. Interest rates,
yeah. As about 60% of our customers take our financing, and we have enjoyed the ability to lend at call it an average coupon rate of 12.5%. And up until recently, our cost of funds have been sub 2%. So it's been a very lucrative business. Obviously, as the base rates go up, the spreads will tighten a little bit. And as a result, we'll see a little bit of degradation in the spread, but it's still a very, very positive and profitable business for us. One would say, well, just raise your coupon rate accordingly, but based on the customers that we deal with, which are typically at the higher end of the spectrum, they're a little more sensitive to those high interest rates. So we have to temper whether or not we raise the rates and potentially somebody who says, well, I'll just write a check versus doing it at a slightly lower rate and taking a little less spread.
What kind of change have you seen in the customer profile, especially considering even with Abound, you look across millennials who are looking at travel as an aspiration, but what we've also seen over these past few years is a rise in the number of rentals, even for some of those kind of unique or niche experiences. So where has Marriott Vacations also kind of leaned further into where it can bring that into the portfolio?
That's a great question, Brad. The way we think about it is by putting Abound together, we have 90 world-class resorts. We have the ability to use your points currency across 8,000 Marriott branded hotels, 2,000 rental homes, a couple thousand of different kinds of experiences, whether they be culinary or arts or guided tours or everything else. We actually think this is very, very positive for folks that are looking for a variety of vacation experiences where they don't have to go outside the system to be able to take advantage of that. And that's one of the reasons why we've moved in this direction.
Steve, thanks for being here. Steve Weiss is Marriott Vacations Worldwide CEO. Thank you.
Okta is coming off a better than expected quarter despite big companies looking for new ways to cut costs with a potential recession looming. The company raised its outlook as demand remains strong. Customers looking to invest in security infrastructure. Joining us now for more on the state of the software space is Okta co-founder and CEO Todd McKinnon. Todd, good to see you as always. Look, you were one of the few software players to actually raise your outlook. What gives you the confidence in doing so in this type of volatile environment?
Well, first of all, thanks for having me on. It's great to be on Yahoo Finance once again, Brian. Our success is driven by, in the big picture, three big trends. And these trends are long-term and very enduring. The one is companies want to do more with cloud computing. You talk about managing through a choppy investor market and potentially a choppy economy. Companies want to do more with less. And that's what the cloud is all about. The cloud is about using this modern technology to make your workforce more productive and lower your costs and increase your revenue. That's one major trend that's driving us. More cloud, you need more identity to manage it, and we sell identity, so that's good for us. The second major trend is companies want to get closer to their customers. They want to build better websites and mobile apps and have that great customer experience. You want to be able to go online if you're going to take a vacation and check your reward points online. You want to be able to interact with all of the products you use as a consumer online, and companies want to invest to make that customer experience great. And identity is at the center of that. And finally, they want to do it all securely. It's no good if it's easy to use and convenient if it's not secure. Companies don't want to be hacked. They want to be secure. They want to keep their customer information secure. And we help them do all of that. And that's why we're confident raising our outlook and going into the remainder of this year and the years ahead.
Well, all that stuff sounds fantastic, but all of it takes money. And right now, with the headwinds that we are hearing about, with the sentiment certainly that we're hearing about from a lot of CEOs, maybe they're going to be less willing to open their wallet, to open up their budget, to write you guys a check. Are you seeing any signs of that kind of pullback, in your customers?
We're not seeing that. Demand remains robust and our pipeline is strong. I think the one thing that gives us, we're obviously like everyone else, we're being reactive where it makes sense and doing what we need to do to navigate the choppy market and potentially the economy changing direction. But the one thing that gives us confidence is it's not just us speculating that these demand trends are robust. If you look at something like the Gartner CIO survey, CIOs are surveyed and they say over 2/3 of them say they have to continue to invest in security. because it is a pillar of what they're trying to do. And also a lot of the products we sell help customers not only raise revenue on the top line, but cut costs. You're talking about taking out legacy infrastructure that may be costly to maintain, costly to patch, costly to modernize, and we can help them do that less expensively.
Even right now, as some of the major tech companies are identifying where that revenue is going to come in from, even if there is an outlook that looks solid or sustainable, they're still looking across their headcount and making some of those either freezes or reductions. Where is Okta at in that kind of headcount and the resources that are necessary in order to hit some of the targets you've set forth?
We're consistently over the last few years and over the next few years, we're investing for growth. We are on target for our commitment to be at $4 billion plus of revenue by FY26. That includes growing at least 35% each year in revenue. And so that's going to take investment, and that's going to take people. People are at the heart of our products and what we do for customers and how we make them successful. And one of the things about some of these hiring changes you've talked about is it gives us the chance to go out and hire talented people and bolster the amazing team we have. The labor market, as you've covered so well, has been pretty tough the last few years. And I think one of the silver linings in some of this economic uncertainty is that I think the labor market might get more flexible, and it gives us the chance to bring on even more amazingly talented people on our team.
Todd, just the tone change in tech land has been stark the past month. For hiring freezes, less growth when it comes to hiring. Looking longer term, how do you think these decisions will impact the longer term future of your company? Not necessarily you're pulling back on hiring, but how does it impact your company and then tech more broadly?
Well, I think that you have to take the long-term view, and we're all about this at Okta. We know these trends of digital transformation, having to be secure, having to invest in the future, whether it's better tools and technology for your employees to make them more productive, making it easy to use, or it's investing in your customer experience and connecting with that customer. Those are enduring long-term trends, and market sentiments go up and the news cycle goes around and around. And we're investing for the long term. And we think what we're providing to customers, this identity platform that helps them accomplish all these critical business objectives they have, are going to be valuable today, next week, next month, and in many years to come.
Okta CEO and co-founder Todd McKinnon, thanks so much for taking the time, taking our questions here.
Let's stay on the theme of what the Federal Reserve did yesterday. The White House has made it clear that the Fed has a big hand in addressing inflation. So naturally, The question is, how does the administration view the big move from the Fed yesterday? Let's bring in Bharat Ramamurthy, Deputy Director of the National Economic Council, who joins us live. And Bharat, it's great to have you on the program. Obviously, the Fed making a pretty abrupt pivot before yesterday's announcement to that more aggressive interest rate hike. How are you kind of thinking about that? We know the Fed has the ability to lower aggregate demand. Thoughts on what you heard from Jay Powell yesterday?
I think what you heard from Chair Powell was similar to what President Biden has been saying, which is that we're in a transitionary phase right now in our economy. We've had a remarkably fast and equitable recovery from a recession under President Biden's leadership. And now we're in a transition phase where we're going to move towards steady and stable growth. And it's going to take a little bit of time to make that transition. But as I've been saying, the analogy I would use is that when we came into office and we were starting a marathon, we were a couple of miles behind some of our competitors, and we had to sprint to catch up. And we sprinted and we've caught up and we've actually taken the lead, but you can't sprint the whole marathon. You got to find a good steady pace that you can maintain over time. And that's the period that we're in now.
And the suggestion from the Fed chairman, certainly that, it's not like we're going to see inflation go back down to 2% tomorrow as a result of that move. But broadly speaking, the conversation has kind of shifted from, okay, yeah, well, inflation could tilt us in a recession, but so could an aggressive path of rate hikes from the Fed. Is that something that you in the White House are worried about?
When you look at the economy as a whole, we're in very strong position. Consumer spending remains robust. Business investment remains robust. The unemployment rate, of course, is 3.6%. It's an extremely strong and resilient labor market, and not at all what you would necessarily have projected a little while ago. Remember, when we took office, the projection was that we would have 5% unemployment for years to come. It would take a long time to reach the point that we're at now. So we think that we are well positioned to handle what are, truthfully, a number of headwinds, most notably the Russia-Ukraine conflict, which is sending energy prices through the roof and affecting the prices of other commodities like wheat and other food products. So there are significant headwinds. I don't want to downplay that, but it is thanks to the president's economic recovery plan that we in the United States are better positioned to face those challenges, frankly, than many other countries.
Bharat, it's Akiko here. There are questions about to what extent the administration can move on anything in the face of this inflation, how much of that you can actually control. And we did see the president yesterday put out this letter addressing it to the major oil companies, calling for increased refinery capacity and output in the near term. I realize publicly this is what the president has said, but when you look at the broader market, I mean, if you're looking at a 5-year, 10-year timeline, the market is clearly moving away from fossil fuels. So how do you make the case for adding new capacity in the face of that?
Well, look, I think I want to provide a little bit of context on this. If you look at energy prices, which are obviously playing a massive role in the inflation that we're seeing, fully 50% of the headline inflation that we had last month was because of energy. And where we were at the beginning of this year, before Putin's aggression in Ukraine, we were looking at global price of oil of about $70 a barrel. That shot up since those actions up to $120 a barrel. That's a big part of the story. Another big part of the story is what's happening at the refiner level. When we had $120 barrel oil before, prices at the pump were $4.25. Now they're about $5. And so that 75-cent delta comes down to the higher margins that we're seeing at the refinery level. As the president called for in his letter yesterday, he wants to put any creative ideas on the table that we can to expand refinery capacity in the short term. And as you said, there may be arguments for why in the long term we need to transition away from fossil fuels. But there are also maybe opportunities for us to expand refinery capacity in the short term in a way that makes sense for the industry and makes sense from the government's perspective. As the president said, he's open to using authorities that we in the government have to help ease that path. If the companies can put on the table a set of policies, a set of ideas that are viable from our perspective.
When you look at the surge in energy prices, it certainly put the president's climate agenda, at least publicly, in a very tricky position. And I know the president tomorrow hosting a forum on energy and climate. And, I wonder how you tackle the messaging. I mean, on the one hand, you hear the president talking about increasing refinery capacity. You've got the president making the visit to Saudi Arabia to get more capacity output as well. And yet that's inevitably going to increase emissions as a result. I mean, how do you balance those two agendas?
Well, look, I think it's always been a slightly more complicated story than people have made it out to be. I think in the long term, the president has been entirely clear that we need to transition away from fossil fuels to clean energy. And I think the events of the last year or so have underscored that, have underscored why, from a financial perspective, in addition, and a national security perspective and a climate perspective, it's important to move away from fossil fuels to clean energy. But it was never the idea that we were going to do that overnight. It's just not feasible to do it that way. And oil and other fossil fuels are going to be a part of our energy mix for some period of time, for some years to come. That was always part of the plan as well. So yes, we have to figure out how to manage that transition effectively. I think what we saw was a massive drawdown in refining capacity in 2020 when demand for oil and gas went down. But it's been very slow to recover. And I think if we look at it financially, for those companies, it's been very potent. The big oil companies, the top five, have made $35 billion in profits in the first quarter of 2022. And they're sending a lot of that back to shareholders rather than reinvesting in production. What we are trying to do is figure out in the short term and the medium term, how do we bring more capacity, refining capacity back online so that we bring down some of those margins and provide relief to consumers at the pump. And at the same time, we do need to work on transitioning away from fossil fuels in the long term. And the president has put forward a climate package to Congress that he hopes that they act on.
So I guess then, to drill down on that point again, is that a contradictory message to send, that you would want to turn on more refineries and do more production at the same time you're trying to lower the amount of environmental impact of all of this? How do the other world partners factor into this as well, given the interest in President Biden having a conversation with Saudi Arabia and other oil-producing nations?
Well, look, we've been clear that oil was going to be a part of our energy mix for some time to come. Already, we've seen more domestic oil production last year than we did in the first couple of years of the Trump administration. The projections are that we will have more domestic oil production next year than we've had in any other year in our history. And so we think that there is a business case for increasing refining capacity. And as we said, if there are things that the government can do to make that business case a little bit stronger, we are open to considering them, because this is a critical way of providing relief to consumers at the pump. And the number one priority that the president has is tackling inflation, providing relief to American consumers. And we think that this is a big lever that we have to do that.
Finally, Bharat, I'm noticing you're wearing a green tie. I can't let you go without asking about the NBA Finals. Brian and I have been watching your Twitter feed. The Celtics are on the ropes. They're gonna avoid are they gonna avoid elimination tonight?
Well, look, I'm glad that you noticed. I did wear my green tie as I'm trying to do my small part in cheering on the Celtics. I am confident about tonight's game. The Celtics have been a very resilient team, as resilient as our economy, for me to stay on message. And I'm hopeful that they're going to bounce back in Game 6, and then you never know what could happen in Game 7.
All right, well, we'll see. Hopefully no downturn for the Celtics. I would personally like to see Game 7. Bharat Ramamurthy, Deputy Director of the National Economic Council, thanks so much for stopping by this morning.
It's hard to find a good deal on new or used cars. Meanwhile, monthly car payments hit a record of $712 a month in May. And that's before you add in the record high gas prices at a national average of over $5 a gallon. So is now the time for electric vehicles to shine? Well, I'm joined by David Underkoffler, editor-in-chief of Autolist, and our very own reporter, Pras Subramanian, to find out. So we're going to start with this survey that your company came out with. EVs apparently still not cutting it for consumers, but it's due to price, range, and poor charging infrastructure. Break that down for us.
Yeah, that's right. So we asked consumers over the past few months, what are the top three reasons, pick top three reasons you wouldn't buy an EV. And those are the three reasons people chose. And we've run this survey for a number of years, since 2019, 2020. We took 2021 off, but ran it this year as well. And yeah, those have always been the top three. Consumers are very consistent. Price is the number one reason they're not buying an EV. Range is the second reason. And then charging infrastructure, anxiety over where they're going to charge the vehicle is always number three.
Hey, so this is Pras here. So are people not willing to pay a premium then for those EVs, or they want to just basically they want to have EVs kind of cost the same as those gas-powered equivalents?
Yeah, that's exactly it. They're looking for price parity. When we ask people, okay, how much more would you be willing to spend for an equivalent EV versus its gas price counterpart, the most common answer was no more, right? So there's interest in EVs. We certainly see that on our search traffic and inventory. As gas prices go up, you see more people looking at EVs. But once you get them to that point where they need to spend more for that vehicle, they're not willing to do that.
So then, is it just that the EV market hasn't done a good enough job of really sort of helping consumers understand the upfront cost versus some of the longer term benefits?
I think that's some of it, certainly. Yeah, there is certainly something to be said for the long-term service life of electric vehicles. There's far fewer moving parts in these things, so they need a lot less service over the lifetime of the vehicle. But in our experience, looking at how consumers are imagining this purchase, they aren't necessarily taking sort of a long view. They're looking at sort of the upfront, the monthly payment, and they're not factoring in insurance costs or service costs. So that's sort of where we're seeing that difference.
Hey, David, so what's getting a lot of play this recent times is high gas prices. You guys asked your survey respondents about that. How does that weigh in the factor into choosing an EV versus a gas-powered car?
Yeah, this was a little bit of a surprise for us. The number one reason, so we asked people, okay, what dollar per gallon would the price of gas need to hit in order for you to consider an EV for your next vehicle? And the most common answer was actually, it's not about the price of gas. I wouldn't choose an EV for other reasons. And those go back to the reasons we mentioned at the top of the segment: price, range of the vehicle, and where to charge it. So it's, one might think, okay, I'm sitting here, I'm in California, gas is $7 around the corner. $7 a gallon, but there's a disconnect as I'm pumping that gas into my vehicle, it doesn't mean that I'm going to then run around the corner to my dealership and buy an electric vehicle. That's not how consumers are seeing it.
And obviously people trying to sort of figure out how to spend their money right now and what they should be holding on to. But then you also have things like tax incentives for things like EVs that were very popular. You see some countries cutting these subsidies like China. What sort of incentives would really make more people want to get EVs?
Yeah, so we asked people this question sort of two different ways. One, we asked, are you in support of more state, federal, and local incentives to buy EVs? And there was pretty widespread support for that. It was about 2/3 of people, 65%, said that they supported that. But then we also asked, do you support lifting the current cap of every automaker gets 200,000 vehicles that are eligible, that's either electric vehicles or plug-in hybrids that are eligible for a federal tax credit. And that support was actually more mixed. So a little bit of disconnect there. You saw just this week that there were some automakers, the CEOs were asking for that cap to be lifted. That's certainly something that would keep up with the markets in Europe and China. You do see more incentives offered there. And I think that the popularity of EVs in those markets reflects that.
Hey, Dave, looking at the types of EVs that people are buying and that they're interested in, or what are you guys seeing in terms of what the types of cars they want to get, in particular pickups?
Yeah, so we're seeing some movement in this segment, right? When we first started running the survey a few years ago, even in that short amount of time, there weren't the same number of vehicles or types of EVs that have come to the market since then, right? So you're seeing crossovers are really what we drive no matter the propulsion, right? Whether it's internal combustion or EVs, we like crossovers in America. We also like trucks. And so those are the two segments that you're seeing a lot of movement. A lot of people are starting to identify them as, okay, I currently drive a gas truck, but I would be interested in an electric truck. What's also notable is that in that time, we've seen a lot of big automakers, Ford as the lightning you're showing right there. That's going to be a really interesting inflection point, because I think that's going to show a lot of people who maybe haven't previously considered an EV that, look, this is offering many of the daily use case benefits of my current truck, but now it's only electric. It's not a big change to their daily lifestyle of using a vehicle.
I will say I'm more likely to dip my toe in with a hybrid than go full electric, but it's mainly because of that charging station issue. If that changes, maybe I'll change my mind. A big thank you there to our guest, David Underkoffler, Autolist Editor-in-Chief. Thank you for joining us, and our very own Pras Subramanian.
Gas prices ticked down a fraction today, but still averaging $5 a gallon for the first time ever. President Biden demanding action in a letter reading in part, "The crunch that families are facing deserves immediate action. Your companies need to work with my administration to bring forward concrete, near-term solutions that address the crisis." Frank Macchiaroli is a senior vice president for the American Petroleum Institute. That's a trade association that represents more than 600 oil and gas companies. Frank, it's good to see you. Thanks for coming on. What's your reaction to that letter from President Biden?
Look, we're pleased that the administration is finally engaging on this important energy challenge that the country faces, but it's their policies that have helped put us in the situation that we're in. From day one, this administration has closed important pipeline projects, shut off access to oil and gas development on federal lands, proposed tax increases on domestic producers competing globally. And so they really need to not just rethink their rhetoric, they need to rethink their policies to help the American people and to strengthen our energy security.
And Frank, what would those policies look like?
Well, here at API, we released on behalf of the oil and gas industry a 10-point plan called 10 in 22 that really gets at these energy security issues. First of all, we asked the administration to issue a 5-year program to open up areas on the outer continental shelf for development of oil and gas. We work on permitting. We tell the administration that they ought to get moving on expediting permitting for critical pipeline infrastructure projects. We also tell the administration that they need to move away from this, kind of underinvestment rhetoric, telling folks that they need to move away from investment in the oil and gas industry. Those are all the, steps that have constricted or restricted supply here in the United States. They've helped, drive prices up. We need to move away from that. And hopefully this administration and Congress takes action now to help the American people.
We know that President Biden obviously has his green plan that he wants